Welcome to Fintech Brews and News, brought to you by Central Payments and Falls Fintech. I'm Nikki Rohde.
And I'm Trent Sorbe.
Founders, co-founders, payments professionals, and, well, just people who love brews. This is a place to get a behind-the-scenes look at unique partnerships and ways to bridge the financial gap between banking, startups, and the entire fintech industry. Whether it's a beer or coffee or something else, there's certain to be a brew in every episode. After all, how do we function in this space without it? Each episode, you're sure to take away some good stuff going on in the financial technology space. So without further ado, let's grab a brew.
Hello, everyone. Welcome to another episode of Fintech Brews. I'm Trent Sorbe, the CEO here at Central Payments. I'm very happy today to be leading a discussion on the regulatory world with which all of us in fintech operate. I'm joined by three very much subject matter experts. Dan leads a venture capital firm called Nevcaut Ventures. Dan, welcome to the show.
Great to be here. Thank you for inviting me.
Wonderful. And then, of course, Eric Goldberg is with us. Eric is a partner at the Akerman law firm. And Eric is certainly a well-respected fintech compliance regulatory attorney. So, Eric, thank you for joining us today as well.
Thanks for having me here, Trent. I appreciate it.
And then finally, Jessica Drew is with us today. Jessica is general counsel at Central Payments. She joined us in August. Jessica comes primarily from a banking background. And so, Jessica, tell everybody a little bit more about you.
Yeah. For the last couple of decades, I've been involved in three different banking opportunities. The first one, I started at Renta Bank and was there for about 8 or 9 years. And I had the pleasure of watching the banking industry evolve through that, the payments industry. And then I went to traditional banking for a little while and found my way back to our fintech area here, which is way more fun than traditional banking.
Yeah, once you get payments and fintech in your blood, it's hard to get it out. So awesome. Well, let's just take a minute here and kind of give a little background on everyone. Let's go back the reverse order. Eric, give everybody just a little bit of information on your background and how you kind of found yourself in this particular space.
So I've been working in consumer finance for most of my legal career, which is getting to be longer than I like to admit. And started off doing a lot of consumer finance litigation. Then there was this new agency created called the CFPB, which I am sure we will talk about quite a bit today, and where I first met Dan. And I went there shortly after the mortgage crisis as a regulatory attorney, where all but me and one other person were working on mortgage rules. So the rest of us had to figure out what was going on in the payment space, and led the development of rules around remittance transfers and prepaid accounts, which I'm sure is near and dear to your hearts at Central Payments. I left the CFPB about 4 years ago to join Akerman. We're a national law firm. We have about 70 lawyers that do consumer finance. I lead the work we do with fintech. We work a lot with startups, more established fintech players, issuing banks, banking as a service providers, sort of the range of characters that you come across in the fintech space. And thanks again for having me here.
Yeah, wonderful. Dan, give everybody a little background on you.
Sure. Yeah. So in the past decade, I've been, living and breathing fintech or financial services. So I as Eric mentioned, he and I worked together at the CFPB. I was serving as a senior advisor to the first director, Director Cordray, and my main portfolio was to be the bureau's eyes and ears for fintech. So really, I now recall that my days there, I spent countless hours flying from Dallas Airport to SFO on those cross-continent flights. I really find myself loving fintech, and left the agency in 2018. I've been doing angel investing on the side, and also advising fintech clients on policy, regulatory issues, and at times on their business strategies. And about 18 months ago, I met my partner, Eric, the other Eric, not this Eric, and we formed this fund, Nevcaut Ventures, and our focus is really early stage fintech and insurtech. Our sweet spot is pre-seed to up to Series A, but we also at times make opportunistic late stage, growth stage investments. Glad to be here.
very happy to have all three of you here. Now, today's conversation, we do call this Fintech Brews, and if there's ever a day that I wish we had a couple beers in front of us, it's for this particular conversation. Unfortunately, it's early enough in the day that we don't. But today's conversation is about what we're kind of calling a regulatory reckoning, and I don't know if maybe that's a little bit melodramatic, but I think anybody that's in payments and fintech recognizes that the last 12 months or so, we certainly have seen an uptick in the attention that the sector is getting from, almost every regulatory agency that's out there, from state regulators to the federal regulators to the FTC, et cetera, et cetera. And so I think today, maybe to kick it off, I think it would be great to kind of work through the timeline and get an idea of what we've seen out of some of these regulators that are particularly focused on fintech. I think we'll start with probably the two regulators that we've heard the most from here recently, the OCC and the CFPB. Dan, why don't you kind of take us through in your mind, and of course, both you and Eric come from the CFPB, but take us through in your mind what's captured the CFPB's attention and why we hear them talking about fintech more than maybe we have in the last few years.
Sure, yeah. So obviously, so when Eric and I were at the CFPB, fintech sort of started to sort of come of age, if you will. So you saw some large players being formed, growing, like SoFi, Lending Club, Prosper. But I think in the last couple of years, this is sort of post what I call post-Rich Cordray CFPB era, fintech has really become a force to be recognized. So so the kind of risks that fintechs, but I think the risks with fintech has not really changed so much over the years. But I think given the growth of the fintech sector, all of a sudden those risks are brought up front and center from regulatory perspective. So I think that's why we see lots of attention being paid to fintech. In the earlier days, people will say, "Let's study, let's try to understand." Now it's about, okay, I think we have studied enough. Let's actually take a closer look. Is there something we can do to either to manage the risks that the fintech is posing, and also try to foster the good aspect that fintech can bring to consumers and to the financial system.
One of the things I've seen, particularly out of Director Chopra, really since Money 2020 in October, we start to hear this term that seems to go in ebbs and flows in this space around the old Renta Bank term. And the director seems to have dusted that term off here in the last 12 months. And it is a term that comes up more and more in relation to fintech relationships with banks. I'm curious, Eric, how would you describe that particular arrangement that gives what are the characteristics of an arrangement like that give regulators, community groups, et cetera, heartburn? And how would you kind of draw the distinctions between, a Renta Bank, which certainly has a very negative connotation, and real legitimate bank fintech relationships? Do you have an idea of where that line is in some form or fashion?
Yeah, I think part of the problem is the line is sort of where is in different places for different people. And you mentioned the consumer groups, and I think to a large extent they have the ear of the director on these things. So a lot of this Renta Bank stuff is not really a new issue. It goes back to people, exporting interest rates out of certain states to avoid usury and all that. And certainly there's situations where that has had, negative connotations and negative impact on consumers. A lot of what we see, though, is fintechs relying on a bank because it's not easy for them to issue a Visa or MasterCard because they're not a bank, right? And they want to offer a product to consumers. It's not obvious to me how just offering a payment card to someone because you're not a bank and partnering with a bank to do that harms anyone. Where I think we've seen the CFPB not really be that clear. On the one hand, they don't want people, I think, taking advantage of these usury rules or taking advantage maybe of banks that aren't sophisticated enough to realize what they're doing. On the other hand, I think you keep hearing the director reference competition. Like every speech he gives, he mentions competition. He comes from the FTC where antitrust was a really big deal. And if anything, I think if you gave him a truth serum, he'd say he really wants to sort of chip away at the big banks. And I think he realizes that the fintechs are helping him do that. On the other hand, fintechs are like any other business segment. There are some out there that are good and there's some out there that are not good. And I think the Bureau is, you've seen them file some enforcement actions against some bad actors. And then in other areas, whether in some of the newer fintech areas like earned wage access and buy now, pay later, they've kind of hemmed and hawed a little bit where they're not exactly sure where it shakes out. So I think a long-winded way of answering your question, the Renta Bank is sort of a historical thing that he has the consumer group saying, it's a bad thing, people are getting harmed. But I think their investigations are not quite sure where that line is drawn. That's why you've seen like this deep dive into buy now, pay later. You might see something similar into EWA coming up to try to figure out how that shakes out. Because on the other hand, there's certain things that the traditional players do that the Bureau certainly doesn't like. And if it cuts fintechs off at the knees, like that's not really helping anybody. That just empowers the incumbents.
It does seem like, it does. And it does seem like there's sort of this triangle, if you will. Like at one point we know there's a distaste for very, very large banks, right? That's not anything new. I think there's also, then we have real obvious bad actors, right? Just the slam dunk, horrible products that, there's no question. And I think the third point might be what's coming now is big tech, right? I think there's a big apprehension around big tech, and how that's going to change the consumer experience and all the issues around data security and privacy, et cetera, that go with that. I'm hoping that somewhere inside that triangle, the rest of us can sort of operate, and that's where I'll be on my soapbox a lot during this conversation, I'm sure. But I hope we can find a place to live inside of that world. Jessica, you come from the banking side of things and not the regulatory side of things. I am curious, your experience as you've kind of come through payments and you've come through as the CFPB emerges. How would you characterize from the banking side of things, the way in which banks might be looking at fintech partners and having to balance the regulatory pressures that they feel every day?
Sure. A couple of things there. I think before I left my latest traditional banking opportunity, I listened to the leadership of the bank indicate that they were relatively scared of the fintech industry coming forward. It is an enormous source of competition for them. So it's certainly something that they are concerned about as it relates to growth, deposits, things like that. Other things to think about are the relationships with the small banks and their reliance on banking as a service relationships, and whether that is going to be affected by increased regulatory scrutiny.
Yeah, I think there is an apprehension inside the banking community that these relationships, by just simply a speech or an announcement, are somehow inherently significantly more risky than others. And I think, I'd be curious on anybody's comments on this. And maybe, Dan, you're in the best position, in the VC community. But to what degree do you think some of the very recent news coverage around crypto and the FTX experience and et cetera has put a cloud over fintech, even for some of us that aren't involved in crypto, but sort of almost guilt by association tangentially in some form or fashion?
Well, I think guilt by association probably is a very much a accurate description of this. So I do think over the years, fintech has somehow lost its luster, from the earlier days, right? I think I don't recall which regulator actually recently talked about this, which is that a lot of the promises fintech has, promised to consumers, to regulators, to policymakers haven't really been delivered, especially with regard to financial inclusion, that sort of things. And I think there's some truth in it too, right? So I think what we have seen, frankly, over the last 10 to 12 years, the innovation really has been mostly happening on the edge, on the surface. What I mean by that is the products themselves haven't really changed, right? A loan is a loan, a credit card is a credit card, debit card is a debit card. Some debit cards may have high fees, low fees, but they're debit cards, they're DDAs. Fintechs have really done a very good job in terms of customer acquisition, in terms of creating a very user-friendly, smooth experience for consumers. But if you open the sort of the shining layer, right, veneer, if you look inside, underneath, nothing has been really significantly changed. So I think I mean, part of the reason we are still very optimistic about fintech from an investor's perspective is that we believe in the next 10 to 20 years, we'll see more innovations really happening, what I call a fintech 2.0, 3.0, really inside the core system, the pipes, the connections, the engines that really power financial services. So I think with obviously a lot of headwinds in the last 12 to 18 months, especially recently with the FTX implosion, fintech probably got a little bit of bad rap, and also obviously the public markets have not been helping. Right, we look at some of the very prominent fintechs that went IPO or SPAC last year. Their valuation, their market cap has dropped, more than 50 or even 70%. But I think this is temporary. We believe, once the inflation is tempered, the interest rates are stabilized. In the next 3 to 4 years, once we can survive this winter, we'll see another high growth again in the fintech space.
So you're predicting a nice rebound, Dan. Is that what you're saying?
I absolutely believe, yeah. Otherwise, I wouldn't be in this business.
Hey, Eric, quick question, because I think you're probably about to go there, but I'll see if I can read your mind. As we think about the repercussions of an FTX experience and some of the more public fintech-related media stories, describe the pressure the Bureau feels when the view is these weren't regulated. You should have been harder on these companies. How could you let it get this far? Describe the pressures and maybe the unintended consequences of that.
Well, I think, you talked a little bit, are people going to be painted with a broad brush because of a few bad actors? I think that's sort of the invitation a regulator needs to look deeper. So you look at the FTX debacle is a good word for it. They had a bank that issued BlockFi, which also went bankrupt, had some pretty generic products that were issued by a bank in connection with these companies. And, there's been a lot of discussion on the other side about, who's vetting FTX and the BlockFis of the world, who's doing due diligence. And maybe the bank here did a great job, but I think it's certainly going to raise questions in people about how are these companies onboarded. We've seen, there's been a couple of examples this summer of increased scrutiny from issuing partner banks of some of our clients. And, we never really know what's provoking those questions, whether it's the regulator asking or whether it's the bank getting ready for the regulator to be asking. But I definitely think you see this a lot in regulation. There's closing the barn doors once the cows have already escaped. I think I got that right. And I think you're going to see some of that now. Congress is going to be having a hearing on FTX, and they're going to be asking the regulators, and they're going to put a panel up there. And so I'm certain there's discussions now at the CFPB, what can we do to prevent this? The challenge, of course, is most of the issuing banks here are not directly regulated by the Bureau. They're less than $10 billion in assets. And, you mentioned the OCC, you mentioned the CFPB. We've not really talked much about the FDIC or the Fed, and they've been relatively silent in a lot of these discussions over the last however many months. And I think that, and some of the interactions we've had with some of those regulators have sort of shown that they maybe have not paid as close attention to this. So I do think, there's going to be closer scrutiny there. The FDIC chairman's getting new chairman, the same as the old chairman, is getting confirmed, in the coming weeks. And I think there's going to be attention on all of this now going forward.
One of the things I hear all the time, and Jess, you've probably heard it too, where's the easy regulator? Boy, the OCC has come out. They've been very outspoken. The CFPB has been very outspoken. Does that mean that the FDIC and the Fed are the easy ones? I know that's a dumb question, a big layup question, but how would you, what are your thoughts?
Well, I've worked for banks that have been regulated by the CFPB, the OCC, the FDIC, Federal Reserve Board. So I don't really want to call any of them out as being easier than others. MetaBank was certainly regulated by the OCC during a time where everything was evolving and the industry was learning and having a lot of lessons learned. So I think as it relates to regulatory scrutiny, there's a heavier emphasis from the OCC on payments than, rather than the FDIC and Federal Reserve. And those banks too are generally your smaller banks. And so from a risk standpoint, they're not going to be as pronounced as, your national banks.
So Jessica, picking up on your concept of learning, I'm going to take it over to Eric. There is an opportunity to learn from a regulatory action. Now, I don't wish enforcement actions on anyone, but I do believe, and we've seen it now, the very recent enforcement action with Blue Ridge Bank by the OCC went into great lengths to discuss the types of bank partnerships that they believe banks should be looking for, and what are the characteristics of relationships that banks should shy away from. I guess, Eric, how would you characterize the enforcement action and what we can all learn from it?
Well, one thing that's been challenging is sort of outside counsel to clients on either side of these bank partnership relationships is there has not been a lot of guidance to date on how to set them up. And you talk to one bank and they say you need all these things, and the client's like, well, that's expensive. So they talk to another bank and they said, oh, sure, we'll onboard you in 60 days. And there's been a bit of the Wild West out there because the regulators haven't given a lot of guidance. And on the one hand, regulation by enforcement is not great. We would rather get guidance in a non-enforcement matter because it seems like someone there was the guinea pig or the easy target. But the Blue Ridge settlement really gives out really clear guidance for what the OCC is looking for in these bank partnerships and what they, in their view, didn't find in place at Blue Ridge. And one is the third-party risk management program. The OCC has pretty old guidance at this point regarding, banks' partnerships with third parties. Hasn't really been updated to reflect the new fintech environment other than some tweaks here and there. And that is certainly an area they're looking on. They're also looking, BSA, Bank Secrecy Act risk assessment, to make sure that that's something that the partners are doing. I've seen in some cases where the bank will partner with the fintech retains a third party to do their BSA reviews, and it's more of a check the box exercise and actually looking at what's going on in those risk assessments. And then the third is related is customer due diligence. What is the fintech doing when they're onboarding new customers, and is the bank aware of what's going on there, or again, is it relying on maybe on a vendor or someone else, and there's not really clear oversight or checking as to what's going on? And I already that came out in early September, we've seen a lot of people trying to order their conduct based on what's outlined in that settlement.
One of the things I find particularly interesting when I look at these enforcement actions, because I agree with Eric, you can learn so much from them. Not just the Blue Ridge enforcement action, but then also the guidance, the bulletin the OCC put out. I think it was back in August, if I'm not mistaken. Don't quote me on that. We see an added emphasis around the the experience and the qualifications of the fintech partner. That's sort of a new phenomenon. I mean, do you think that the regulators have a view that, you've got these fintechs are two guys in a garage, that have 2 years out of college that are sitting, spending all night coding on their computers. And, do we have a reputation or an image problem here, or what are your thoughts on that?
Well, in the past, I actually have seen come through various vendor risk management programs, two guys working out of their parents' basement with a bicycle. So, although it's certainly not the norm. There may be a misconception that is the case. There are so many startups that are just cutting their teeth on this, and so. I think there may be a misconception of that. I think that we would do ourselves a favor to work with the regulators. I know that they have asked for advice and participation from the industry to really provide them information about our industry, the emphasis that we do already have on third-party risk relationships and oversight. And I think that would do us a favor.
We had Governor Bowman in our Falls FinTech Accelerator office here not that long ago, and she was gracious enough during a visit here to Sioux Falls to, reach out to us and say, I want to spend some time and understand who these companies are that you're bringing through, these early stage companies. What are their backgrounds? What are their experiences? Not from a regulation or enforcement standpoint, but just trying to understand the change in the types of professionals that are being involved in financial services and the way it is becoming much more technology focused. And I think what a great segue to Dan, who now, is making a career out of finding the very best in early stage fintech companies and taking them to market. Dan, what are you seeing in the market today around founders and the way in which founders are approaching not just the products that they want to build, but then the regulatory expectations that are evolving, and do they recognize those things? I mean, maybe the reputation problem is well deserved. I'd be curious of your thoughts as you spend so much time with founders.
Yeah, sure. So, if I can roughly divide, our portfolio companies into two categories. So one category would be those companies are offering products that are sort of consumer facing or serving SMBs. So instantly you see the regulatory requirement and potential scrutiny will be very much heightened. So pretty much everyone in that group, whether the founder or the CEO, founders, CEOs, have any prior financial service background or not, they tend to immediately think about, okay, so how do I make this work? So if they don't have the kind of expertise or experience, they would reach out to, sometimes to investors or through their own networks to find, someone with compliance background or regulatory background. They definitely will very early on seek, folks like Eric to help out. And I think if you're doing financial services, you really need to take compliance very, very seriously. It may not be your top priority when you're small, when you're just started out, but it should always be, in the background at least. And once you are at a stage where you need to find a issuing bank to issue a card or do DDA, then all of a sudden you see lots of requirements from the issuing bank. And sometimes, I think there's a culture shock, frankly, from the founder's perspective. This is something that, if your background was coding, this is something that you would never, ever expect or experience. But then you quickly realize, hey, this thing is not easy. This thing is not cheap. But in order for me to get, from A to B, I need to do all these things. I need to jump through these hoops. So whether they like or not, I think they have to, take compliance very, very seriously. Now, the other category, obviously, are the companies that they're in financial services, but then they're not really dealing. It's more of a B2B, especially, our fund is very interested in investing in SaaS companies. So they deal with another kind of sort of, compliance issue, but the burden is much lower, right? So it's more of a data security, privacy, but SOC 1, SOC 2 compliance. But for them, it's really trying to win the trust from their clients. Sometimes the clients are banks, sometimes the clients are insurance companies. So they have also to cross a very, very, to meet a very, very high bar. So either way, I think if you're in financial services, offering a product that can, generally speaking, you can invite a lot of criminals to it, right? Because it's people's money at risk. So you need to really treat compliance very, very seriously. And I've never seen anyone that says, I don't care about it. I'm going to just go ahead and do it. Frankly, if someone comes to you with a kind of attitude, that's not a company that you want to invest in.
The propensity, I think, oftentimes, having brought a bunch of founders through our Fintech Accelerator, I try to explain to them as much as you want, you cannot code around compliance. And it's not meant to be, it's not their intention to try to ignore compliance, but I think they believe that there is a programmatic way in which you cannot have to think about compliance. And we try to tell them that you're forgetting the subjectivity in many cases that is associated with it. And so I've never encountered any that don't want to take it serious. I think for them, it's like, how come I can't program to it? And I think that's an interesting situation. Dan, I'm going to stick with you because I think it's also relevant to talk about, the current marketplace. Certainly funding is much more difficult now than it was a year and a half, 2 years ago. And then, so if you're an early stage company and you've raised some angel or seed money, you can't go out there very easily and hire Eric. I mean, we're one of Eric's clients. I can assure you from the bills I get, he is not an inexpensive legal resource. So I'm just teasing you, Eric. But I think, how do you tell startup companies to say, look, you got to spend money here? And they're like, look, I only have so much to spend. And this is a very difficult time for me to go back to the well and try to raise more.
It is a very, very, difficult question to answer, frankly. And frankly, given the quick change in the market, there are times we have to pass, deals that otherwise will be very, very attractive, if this was 6, 10, 12 months ago. And so, I mean, I also work with Eric on a few deals together. Eric has been a great partner, great friend, and great lawyer. So I think some law firms, they structure their engagements in a way that are beneficial to early stage companies, so that the bills are not too expensive, but with the hope that if the company grows and scales, and so will the legal fees or engagement. But I think one thing is very, 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 very clear. So I've never seen any founder that sort of, that came to us and wanted to do something in financial services and say, we're not going to get any legal counsel because we cannot afford, and we're just going to go ahead and do it. And frankly, I don't think it's just us. I think if anyone comes to investor with that kind of attitude or belief, I think these guys probably will not be able to get any funding.
Eric, what are you telling early stage companies that come to you and say, look, I really need your expertise here on this?
Yeah, so what we try to do when we're talking with a really early stage startup is sort of give them a roadmap for compliance. Like, you're not going to be Bank of America in your third week. You're not going to spend all of your hard raised capital on compliance, but there's certain things that you can't get away with not doing because you're going to end up in jail, or there's certain things that if you don't do them now, it's going to be really hard to reverse engineer when you've gotten a bit of critical mass. We saw an example this summer where a client had to go back and get new ACH authorizations from all their customers, and it was incredibly costly and complicated because they didn't have a right authorization from the get-go. So a lot of it is just road mapping out for them. Like, look, here, I understand your budget. We're not going to spend all your money on legal fees. That doesn't make any sense before you've proven if you have a working business. But look, these are the building blocks you need. And one area we see a lot of as a first choke point is when they go to the first Series A fundraising, and a lot of investors like Dan, who have a background in compliance, are going to ask them some pretty basic questions. And we've been on the side where we're the ones asking the questions. And if there's not a good answer, particularly now in a tightening environment, I think it's going to be a lot harder to fundraise. If you're a new startup, the CFPB is not going to be on your doorstep in the first 6 months unless you do something crazy. But you are going to have to talk to investors and other people. And investors are experienced in this space, and they know what answers to hear. And they may not expect the Cadillac, but they want to see the plan to how you're going to get to the Cadillac by the time your product reaches critical mass.
And I think, let's take that one step further. The early stage company not only has to talk the compliance talk to investors, but they need to do it to their bank partner. Jessica, if you put yourself in the banker's shoes, what should be the expectations when you're talking to an early stage company that doesn't have endless resources, and to Dan and Eric's point, doesn't have every I dotted and T crossed, but at the same time has the right attitude and the right commitment? How does a bank make that work?
Yeah, I think if it's an opportunity that is amazing, I think that, in the spirit of partnership, they need to work together. There's certainly ways through contracts and risk sharing that the banks can do more on behalf of those entities, especially starting out, until they can get revenue and be able to build out their compliance and risk teams.
Awesome. Well, look, guys, and Jessica, thank you very much for joining us today. It's a challenging topic, and I'm 100% certain that we'll want to revisit it, in the coming months, because things do have a tendency to change. So thank you very much for joining us today. And for everybody who's listening or watching, we're going to put the links to all of that regulatory guidance that we were talking about in the show notes, where you'll be able to read it for yourselves, as well as the contact information for Dan and Eric, who are very much subject matter experts. And of course, Jessica and I are always around too. So thank you very much, and really appreciate you spending time, and happy holidays to everyone.
Happy holidays. Thanks for having us.
Thank you. Thanks for having me.
There you have it. We hope you enjoyed this episode of Fintech Brews and News. Keep up with all the content and cool stuff happening at Falls Fintech and Central Payments by checking out our website, our YouTube channel, LinkedIn, and Twitter. Subscribe to this podcast so you don't miss out on our next episode.
I'm Nikki Rohde.
And I'm Trent Sorbe. See you next time.
Cheers.